right, let's go, and I would like to start here this evening by taking a look at the broad market and what we're seeing, what's going on out there. Obviously, we had a pretty sharp reversal today in the market. So let's take a step back here, and these are some things we cover in our newsletter on a day-by-day basis. Something we presented recently. This is a monthly chart of the Nasdaq, and what's important here is that the Nasdaq has broken out to a new 11-year high, and that mark was at about 28.92, and we're at about 29.15 right now on the Nasdaq. So there's not a whole lot in the way for the Nasdaq. If we hold this level, we could see a pretty significant rally in the market. And right now we're still in pretty much full bull mode, although we may see a correction here over the next several days. We'll just have to see how that plays out. But basically the Nasdaq's leading the train out right now, and as long as it remains healthy, everything should continue over the intermediate run to head higher. Now, if we take a look at the S&P, and we're going to also look at the Dow, you'll notice on the monthly chart that on both of these indices, we face a little bit more resistance. Obviously, we have this previous swing high that occurred last summer, where then we had the sharp sell-off in the late summer and early fall before recovering. So we're coming into that level on the S&P, which is certainly is going to act as a formidable resistance zone. And I'll explain a little bit more about that in a minute. As far as the Dow is concerned, it's been showing a little bit more relative strength compared to the S&P, in that it actually has gone up and tested its swing high. It cut above that level, and now we had a reversal today. So once again, this is the monthly chart. But when you compare both of these out to the Nasdaq, the CompX, you get an entirely different picture, where the CompX has gone through this swing high. So if you're going to get a reversal, an initial reversal, or when I say reversal, initial correction in the market, typically it's going to occur when you at an overcut of a major resistance level. So if we were to get a correction in the market here for a few days or a week or something like that, it wouldn't be a major surprise, because we've had a pretty extended rally here now, and it's been pretty powerful. Now, one thing I do want to comment to, and something we watch very closely, we are basically trend followers. We're swing traders, but we look to follow the trend and not fight the broad market. And so we very carefully pay close attention to distribution days in the market, which are defined as days where an index, namely whether it be the S&P, the Nasdaq, the Dow, the Russell 2000, whatever, if they're down more than about 0.25%, they're down approximately 0.25% or more, and the volume increases, that's going to be defined. We have higher volume day over day. We're going to define that as a distribution day. And over the past several weeks, we've had 2 distribution days on the S&P, and for that matter the NYSE, but we still haven't had a distribution day on the Nasdaq. So the Nasdaq's been leading the charge and holding up really well. In fact, today, although we had higher volume and a sell-off on the NYSE, the same cannot be said for the Nasdaq, as volume was lighter today, even though it reversed and was down. So, what we really look for is when you get an accumulation of distribution days, then you have to have some concern that the market, may be in for more than just a simple correction, that you could actually have a bigger move lower. But right now, there's not a lot of concern. We still have a bullish bias, without question, and it's just a matter of now, the market's got to play out. Now, one thing, just to go over a couple of things here, a couple of different ETFs, just to give you a picture of what we see going on. If I look at the diamonds, what we're seeing today for the first time in quite some time are significant reversal candles. We haven't had, this type of bearish reversal candles in a while. And, this is basically more or less an engulfing pattern where, today's candle basically engulfs the previous day's candle. And it's, it's pretty negative. It's on big volume. And, so you would expect there to be some follow through off of this. But we're not really interested in going short simply because that's going against the broad trend. And we were not, we don't like fighting the market. If we get a trend reversal, then we'll look at going short. And for those of you who are current clients and have been with us, you know that last summer and fall we were short quite a bit, made a lot of money during that bear market pullback. Because we had the reason to be short at that time. We had the distribution days in place, and we were able to see that coming. Now, again, it's something I haven't seen a lot lately, but same thing here in the retail sector. A dark cloud cover, pretty nasty reversal candle here today. And, so at a minimum, it's just a warning sign. It's like, okay, well, this is not a time to be overly aggressive on the long side of the market unless you have a really clean setup. And one other, just to, sort of show you what we're seeing out there, XOP, oil and gas exploration. You have this, this reversal candle where, we have a big, long tail, a long wick on the candle. We closed in the bottom half of the trading range, probably the bottom 30% or 40% of the trading range, and a big volume spike. So once again, doesn't mean the market's going to come apart here, but this is what we look for. When we start seeing these type of candles form all over the place, there has to be some concern. Now, the fact that the market isn't falling in lockstep or hasn't been during pullbacks is good. In other words, we haven't had any days where both the Nasdaq and the S&P, the Dow, everything, they're just wholesale selling across all sectors and across all indices. We've only been seeing, some distribution days on the NYSE and a few on the S&P. But, we haven't had a cluster in accumulation. Now, several things that could provide short-term opportunities. Now, the way we look at this market right now, we're looking at it from the perspective of, all right, we're in a correction. If you notice this line right here, this line, that's the 10-period moving average. And I can type about anything in, and you'll notice, look what we've been doing. We've been just riding in an uptrend, this 10-period moving average for quite some time now. Ever since this breakout, I mean, you couldn't get a cleaner trend higher. I mean, that's just a real clean uptrend. And we haven't even threatened this thing in a long time. I mean, we haven't, in the last 10, 12 days, we haven't even gotten near the 10-period moving average. So, would it be shocking if we came and we undercut this? Absolutely not. Could we come and undercut the 20-period moving average, which is right here? This is the 20. This is the on the QQQ. I mean, sure, absolutely. And to get a modest correction like that is nothing out of the ordinary. But by no means are we interested in trying to short the Nasdaq here simply because we might be in a correction. I mean, we have no evidence that this is at this point, we don't even know if we're going to have a correction. But if in fact it does play out, which it looks like it could, we're not interested in trying to short it because we're fighting the trend. We're still in a very significant and powerful move higher. So, to get a little bit of a pullback here would be no big deal. Now, a couple of things. If let's say we were looking for something on to work with in the short run, if we are looking to get, let's say, short the market, okay, potentially take on something that would give us a play as we're in a correction mode or a modest pullback mode, we would look at something like, for instance, the VIX. Notice how VXX has it has tracked along its 20-period moving average since December, late November, December of last year, and now we've broken through this downtrend line. basically we broke through that downtrend line, and now we've actually we've actually managed to get back up above the 20-period moving average, and for 4 days we've been holding here. So the fact that we're getting some volatility in the market, you could have a possible short-term entry, let's say over the 2-day high, and look for a quick pop. Now, in markets, if we're trading counter trend, we're gonna tend to look for things that aren't as heavily correlated, or things that are showing relative weakness to the market in general. And the fact that we look at inverse ETFs versus trying to short something, the reasoning is that you're not really supposed to stay in a lot of these inverse ETFs more than a day or two. So as swing traders, if we can get just a couple of day move out of them, that's acceptable, and as long as we have reasonable risk reward in place. But if we had to be in something on the short side where we had to look at staying in it for a week or two until it played out, in our opinion, that's the dangerous thing to do, because you're trading against the trend. You're asking a lot out of the market for that to occur. But this is one potential setup above the 2-day high. The VIX could go. Now, one of the problems you do run into when you're counter trend trading is a lot of times you just get gap moves, and you can't chase it. I mean, things gap up and they just go, and you don't get any kind of risk reward that's in line with reality, and you're just chasing the trade, and then they fizzle out very quickly, and so unless you're already in them, they don't work out. But a couple other things that we've had our eye on. You'll notice something. The things that have had relative weakness, because these are all inverse ETFs. If I, for instance, if we took a look at something like, let's say XRT. XRT's had relative strength. It's been tracking along its 10-period moving average. So, that would be something that has really been, leading the market, has been acting extremely well over the past several months. So that's not something that we would be as interested in trying to short, because it hasn't had relative weakness for the market. But if we look at something like SMN, notice that this has broken its downtrend line going back about a week. When it broke out here, it got out of this downtrend line, which was the 10-period moving average, and now it's testing the 20-period moving average. So once again, the fact that it's an ultra short, 2 times inverse, it's something that can provide a short-term opportunity above the 2-day high. But once again, it's a type of trade where you got to get in and get out of quickly, because we wouldn't, and we don't want to trade against the trend. I mean, it's that simple. But the important thing is that it already broke the downtrend several days ago. So obviously, basic materials were showing relative weakness well ahead of today's sell-off. Something that is less correlated to the market, IAU gold, has been holding up really well. We had this big, powerful move out. So on the long side, if you notice, gold can have a tendency to rally with the market, but can also rally against the market during sell-offs, as there is a fear component quite often associated with gold. And today, gold was up on the day, not significantly, but it had this big breakout. It's been consolidating. It came back down into a 20-period moving average already. It broke along a downtrend line. There was this intermediate downtrend line that it broke above on that powerful move out right here, this candle. So now we broke above that, and we've come down and tested the 20-period moving average, and we could be poised for another move higher. And since you have a lower correlation to the market with precious metals than you would, let's say, technology ETF or something like that, this could offer a potential entry on the long side, either above yesterday's high or potentially above this high right here for these 4 candles right here. So something to keep on the radar, and definitely could be a play on the long side. In the event we see further selling pressure, we could see a pop in gold here. Now, what we're more inclined to do right now is to be patient and say, okay, here I have something like XLK, which has been rallying along its 10-period moving average, Now we've been still consolidating for the past 5 days. We had a false breakout today, pretty severe reversal candle. But what we'd be more inclined to do is to look for pullbacks into support. So here's our trend line. If we draw the trend line, here it is. If we get a pullback into this zone where the 20-period moving average, right here, this line, meets up with the trend line, if we get an undercut of this area, this could be an excellent pullback entry. And this is really more of what we would be looking to do. It's just to wait a few days and see what happens. I mean, for all we know, the market could reverse tomorrow and just go ripping higher. Doesn't seem likely given the volume that hit the market and given the big reversal that we saw, but it could. And we don't try to predict those things. We wait to see how it plays out. But at a minimum, we know if we get some nice pullbacks like this and something like an XLK, we come back into these support levels and we get legitimate triggers. This is what we would rather do, is be patient right now. One thing we've been doing over the past week or so, we were in a lot of really good trades, ETF trades that we have exited. We exited them several days ago with with really nice profits, and we got quality good early entries, and now trying to chase things right now is a little dangerous because they are extended, and the big moves have come. So now it's a time to be patient in the market and not get overly carried away and thinking that you just have to grab something because it pulls back for a day or two. You have to exercise a little patience here and let the setups happen. So anyway, that gives you kind of an idea on my thoughts about the market, my thoughts about some ETFs, where some opportunities may lie. What I'm going to do now is turn things over to Rick Petticelli, and he's going to go over with you the stock side of the market and take a look at some stocks.
All right, so Ed basically gave you the primer on the broad market. We're extended, and for the market to pull back would not be out of the question here. I mean, so the question is, do you want to buy new stocks right now? Do you want to buy setups right now, or wait a few days? If you own only 3 to 5 names and that's how you work, I would wait. If you have 10 to 15 names in a portfolio and you want to play 1 or 2 or 3 moves over the next few days, fine. But you don't want to go, and if you have 6 positions, ramp up to 10 over the next 2 or 3 days, or to 11. So if you have already 8 positions on and you're holding and you've maybe taken off a few today, you want to add 2 or 3 over the next few days if you find something compelling. But the point is if you've been very active lately, just chill out for a few days and let the market pull back. See what setups are out there. As far as breakouts, today there was a nice breakout in Celgi. Unfortunately with the market, it sold off. So this is a potential breakout entry. We're going to monitor over the next few days. If it pulls back here and tightens up while the market pulls back, then we might be able to get some sort of pullback entry or just sort of range contraction here for a few days. And all the setups I'll be showing you will pretty much look like Celgi here. You're going to have a 200 AMA and a 50 and a 20 all trending higher, all above each other. We don't do any buying off the lows. Everything is near 52-week highs, at least within 20%. And the only way we'd even go for stocks that are off the lows is if the market was totally crushed like it was in 2009, and there just isn't anything at 52-week highs, and you just kind of go with the flow. HIB is another setup we've been looking at. It's pretty tight here at the highs. False breakout today. We'd keep an eye on it. And I'm just going to show you some stocks that we're keeping an eye on. And like I said before, nothing is really actionable, I don't think, unless you're a very, very active trader. Biopharma looking pretty good as it broke out a few days ago. If the breakout fails, it could pull back to the 20-day or the 10-day moving average over the next 3 days. If that is the case and volume isn't too heavy, that is also a potential buy entry, so another one to watch. And Cintas, CTAS is another potential breakout entry, tight range price action. I'm pretty much showing you guys the obvious breakout points. We have an early entry breakout system that allows us to identify some of these breakouts before they're really obvious, but I mean, that's exclusive to our subscribers of the newsletter, so I really can't go into too much detail on that, but you know, you can make money trading breakouts, so it's not a big deal. Pullbacks. IACI pulled back today. We established a position this today before the market came back in, so as long as it holds above yesterday's low, we're going to stay long. And this is a type of setup that we're looking for over the next few days. Something that's broken out and pulls back to a moving average. Con broke out recently. Nothing to do right here, but if the market sells off for 3 days, a touch of the 20-day EMA would be perfect scenario to go on weakness, temporary weakness. BIIB is already pulled back, and there's a potential buy entry over this range high here, and it's looking pretty good. So if it does break this swing low right here, though, we probably take the setup off our radar and wait for it to get a little bit tighter. CDNS, pretty nice setup. Again, another 2 to 3 day pullback to the 20 or the 1150 area would be really nice. Everyone's favorite, Jazz Pharmaceuticals, which is getting, you know, everyone loves Jazz, it seems. So Jazz is pretty nice. It probably needs to pull back to the 20-day MA, and if it holds the 20, you may get a pullback entry there if you're not already in Jazz, if this is the type of trading that you like to do. And the final one is MNST, and it got sold off today. However, don't give up on this setup, because if it holds support at the 20-day MA and forms a tight range over 3 to 5 days, it's a potential buy entry over that range high. And don't forget I told you that, because this is something to watch, because it just broke out on a gap up and had a false breakout, so everyone's going to get shaken out over the next few days. So that is something to keep an eye on. So to repeat, I mean, if you are an active trader, maybe you want to tone it down a bit, maybe reduce size, or just try not to do too much. And for those who don't trade a ton, you probably should be doing nothing right now and let the market chill out for a few days. So that's pretty much it for the presentation today. Ed, you could take it back and can answer any questions. I believe Ben had a question regarding the moving averages. We use a simple moving average for everything except the 20-day EMA. And the only reason why we do that is because on 20, we use the exponential. We've just found that if on pullbacks that the 20 is support quicker, obviously, then the SMA just responds quicker because of the way the calculation. So the 20 would probably look something like this if there's a pullback, just slightly laggard, just slightly behind the 20-day EMA. So that's why we use the EMA over the SMA. It's not a massive difference, but it's just very subtle, and I don't know, we've gotten used to doing it that way. So you do not seem to respect extended markets. Please explain your thinking. I don't know what extended market is. I mean, every rally we've had is extended, Mike. You just gotta trade, and then when you see 4 or 5 distribution days, you get out. You got to trade the market when it's going higher. This is the time to be getting in with your 5 to 10, 15 positions. Yeah, well, overbought markets remain overbought for a long time. You know, longer than anyone expects. You know, we could rip higher tomorrow. Who knows? You know, what I think this market has had a problem with is that really small and mid cap stocks have kind of underperformed the S&P. And that tends to happen every now and then. I don't think that's the case with every single rally, but certainly in this rally, it's been the case where some of the better looking mid cap stocks or small caps have and just, you know, they just haven't outperformed the S&P. So, you know, when that happens, you really can't change your style. You just have to stick with what you do, and hopefully things turn around. But you definitely have to to get into as many positions as you can, as fast as you can when the market's going higher, because markets don't trend for a long time, and most of the time they go sideways. So you really don't want to give up on anything prematurely. We wait for the 4 to 6 distribution days.
Yeah, I guess the question was on the SOXL. It looks like a pretty ugly entry. Well, what this falls under for us is a pullback entry, okay? And what we're looking for in this scenario is that the semiconductor, we had a pullback and we formed a massive reversal candle. Okay, this big reversal candle right here. So on this day we gapped down and we tested the 10-period moving average. The next day we undercut the low of the previous day. So on the 13th we undercut the low of I think that would be the 10th, right? Yeah, the 10th. And we came down close to this 20-period moving average right here, and we formed a big reversal candle, which tells us that that basically the bulls regained control of the market. And we call this a pullback entry because we had broken out to a new high, and we pulled back to a support level, formed a reversal candle. The next day we got something close to an inside day, just some stalling action, okay, and as volume picked up slightly. And then today we had a gap up and a breakout above this reversal candle. So that gives us, based on our trading methodology, that gives us a legitimate long entry, and where we can place a stop below this reversal candle, and it gives us a good risk reward. Now today, what did we end up with? Well, we held the gap. We did close near the lows of the day, but it was a pretty rough day in the market. So. But semiconductors still held relative strength to the broad market as they closed up on the day when the market was down. So we know the Nasdaq was down 0.5%, in large part driven by a massive correction in Apple, which certainly is not major surprise that you're going to get some pullback there after a big run up. But so basically we've held this. And there's nothing wrong with this trade. I mean, this thing could chop around for another week. As long as we don't break this swing low, then we're fine. The trade's intact. But when you get a legitimate trigger that gives you a good risk-reward ratio, you've got to take on the trade. I mean, you don't not trade something just because intraday the market shifted. We're not going to just jump out of the trade. There's other factors that could play into why we potentially could exit a trade early. But right now, there's no reason to get out of this trade because we held the gap on a big volume day on a pretty nasty reversal day in the market. But it's a clean entry, and it's a pullback entry in an uptrend. And what really is the telltale feature here is this reversal candle. Once that's in place, then we have an entry above that reversal candle, which in this case was this 2-day high right here. And that's what triggered the entry. So, right now, I mean, I'm comfortable with the trade. There's not a real lot to say about it other than we're in, and you got to let nature take its course in terms of, that's why we have a stop in place, and that's why we have risk management rules, and why we take on, reasonable size. Something else I would mention is we were in a lot more trades. Rick brought this up a moment ago. We were in a lot more trades coming into this week. I mean, we've been getting out of trades over the past several weeks as they've been showing good profits. And this ties into what Rick's saying. You don't want to, I don't think this is a market right this moment where you want to try to enter 10 things at once or whatever. There's only a select few things you would want to get in. And we want to be a little lighter in terms of the number of positions we would take on the long side of the market right now. And also to comment to the question about, there was a question or comment about, markets being overextended or whatever. I mean, that term is thrown around generically. I mean, I agree with Rick. We really don't look at things as being overbought or oversold per se, because things can stay in those states forever. But there's periods of time. Every market corrects. And that's why I was very careful about distinguishing between trend reversal and just a correction. I mean, could we see a correction here? Sure. But the correction could take the form of 2 weeks of sideways action or 5 days of sideways action where nothing really breaks down. We base out and we go higher from there. There's no way for us to know that until it occurs. But we don't get hung up on whether things are, gone up too much, quote unquote, too much, because what does too much mean? I don't know what that means. I mean, I've seen stocks, I've seen ETFs do exactly what QQQ did. I mean, I guess by some people's definitions, that's too much. Well, that's what it did. I mean, so that's just an arbitrary label you can place on something. But when you get these kind of signals like this, big volume spike, a reversal candle, a clean, clear reversal candle, you've got to take notice. You can't ignore those things. That's just common sense. So that's kind of how we approach it. But hopefully that answers your question with regard to SOXL. One thing I do want to mention, by the way, is you can go to our website. Those of you who are new here tonight that aren't current members, if you go to our website, morpheustrading.com, you can you can just click on services. You have the ability to basically get a good idea of what we're all about. Click on services if you want to sign up. That'll take you into that. One thing I really do want to point out to you is that we have a complete, and I'm serious about this, no nonsense, 100% money back guarantee. If you're not satisfied with the service, we don't play games. It's easy. You just send us an email and you can cancel during your trial period. So not a problem whatsoever. But I want to point this out to you, and those of you who have been with us for a while, I think you can attest to the fact that we're pretty sensible traders. We don't hype things. We don't get into we have 10,000% performance or this or that every other day, and we made 100% gain last week and all this. I mean, we take on legitimate trades with legitimate risk reward entries, and we teach people the sound and fundamental ways of trading and making money, and also important, protecting your capital. I mean, that's critical stuff. So anyway, back to the Q&A. We'll field the questions here now. Just got to get that little promotional in. Yeah, by the way, one thing about the 10-day moving average, when we tend to look at that, I usually don't even have the 10-day up, but when we get into a powerful trend, that's when we throw the 10-period moving average up there. If we're just in a slop fest chopping around, the market's not really doing much, I won't really pay much attention to the 10-period moving average. But when you get a stock or an ETF that's really trending hard, then then you have to take notice, because the pullbacks don't tend to come back into the 20. They tend to ride the 10 period for quite some time. CAVM. Let's take a look here. Someone's got a question. CAVM. Okay. Well, normally what do we look for on the stock side of things? We look for, and then the same thing with ETFs for that matter, more so with stocks though, because there's too many good plays out there to mess around with ones that have relative weakness. CAVM, I mean, look at all the indices. All the indices, like if you look at the SPY, we're above all the moving average. We're above our 200 period. We're above the 50. We're above the 10. We're above the 20. Everything's upsloping, well, except for the 200. The 200's starting to flatten out. It could start upsloping soon. But we have everything moving, the momentum moving in our favor, versus CAVM, which is, pretty much bottom fishing at this point. It hasn't even broken out of this trading range. We're stuck in a trading range that we've been in now for months. Let's get this line here. So we've been, here we are caught in this trading range. Yes, we lost this major downtrend. We're no longer in this trend. We were in a nasty downtrend for the longest time. So we don't have a trend reversal here, but we've broken above the downtrend. Now, does this thing have the potential here of setting a higher high and a higher low and then a trend reversal? Sure. But right now, it doesn't have a ton of relative strength against the market on a bigger picture basis. And when you compare this out to something that's busting out to new highs, Boys, Rick was just talking about Monster, I think. I mean, here's something that's in an uptrend, that's has all it's got all of its moving averages upsloping. You've got everything going in your favor. So if you get a pullback on something like this, it's got a ton of support. I mean, look at your support levels here. Obviously, we don't want it to break below certain levels, but look at where we have support all over the place here. So we have, support here. We have these moving averages. This is the type of trade where if it holds up and the market pulls back and it holds up and we consolidate, this thing could rip higher another 20 or 30 points versus trying to guess whether CAVM is going to be able to hold up or not. I mean, maybe it does, maybe it doesn't, but there's just better trades out there, much better setups, and that's where we come into play. What we provide our members is a lot of analysis and a lot of research on things that we find that have a much statistically from our back testing and so forth, have a much greater chance of being successful trades than trying to chase things at the lows. And we've never been, it's just not part of our philosophy to do that. We try to stay with the broad trends and stay with things that have relative strength. Okay, no problem, Mike, not at all. CAT, let's see. OPK, let me look at OPK real quick. And OPK is looking pretty good here. We've been watching this one for a while. I mean, what you like so far is that here we have a clustering of I don't know, you call them distinct reversal candles, but at a minimum, what's happening is we have held, at a minimum, we've held this low. 4 different days now, we've tried to get below this mark and unsuccessful. Buyers have stepped in to keep this thing going. So obviously, if we get above this swing high right here, this candle right here, on the 13th, I mean, we have a potential long entry here to take on some size. So if this thing were to gap up tomorrow a little bit, or if it were to rally through this mark, it offered much like SOXL did. We've had a little bit of a pullback. It's held support. It gets back above here. You can take on a little bit of size here for OPK. It's acting pretty well. But the key now is what does it do in relation to the market? If we do get a correction, can it maintain itself as long as it holds this 20-period moving average right here? I'm sorry, is that the 50? I take that back. This 50-period moving average right here, if we got an undercut of that, that wouldn't be the end of the world as long as it came back up into the trading range. So it's acting well. I mean, it's a pretty good looking setup. It just has to hold up here now. Let's see, we got another question here. There was Caterpillar. Okay. Caterpillar. I know that's been acting really well lately. It was one of the bigger losers today. It struggled today, but a lot of things did. But what do we have going on in Caterpillar here? Well, we had a nice base here. We broke out from the base. It's one of the stronger sectors right now. We're testing this swing high. So we probed above it, and obviously there's some discussion going on now. Ever since we came into this swing high, we've had some discussion. We call discussion when you've got the bears and bulls fighting it out and you have consolidation going on. So obviously, if we draw some lines here, we've been trading between here and here for what, 15 days now or so? 1, 2, 3, 4, 5, 6, 7. Yeah, about 15 days, give or take. And it's been, been holding up well. Now, certainly it's sold off pretty heavy today, and that's a pretty nasty looking candle. But as long as it just stays in this range and consolidates, a pullback, if we were to come down, for instance, and say, let's say we undercut this 20-period moving average right here, there would be nothing unusual about that, and it would be nothing out of the ordinary. We'd be staying in we'd be basing out, we'd be staying in a nice trading range, and then it would just be a matter of finding a trigger, a reason that we would enter the stock. And we have specific triggers that we look for, whether or not we enter a stock on the long side or whether we short it. Everything we do is based upon risk reward, meaning we want to see that our reward of entering the trade is at least 2 times as great as the risk of taking it on. So we want stops, if we get stopped out, that we're not going to, we have the potential of making at least twice as much on the trade as we do losing, what we would lose on the trade. And that, in addition, we have size parameters that we don't take on, more than a certain size trade, and we don't want to risk more capital on any one trade than what's prudent. We have a whole set of rules as far as what our setups look like and how much we risk and what kind of reward to risk ratio we're looking for. The Caterpillar looks really good now. I mean, this is a good looking price action here, and now it's just a matter of letting the next setup occur. And interestingly enough, Rick and I were talking about this before we came online here this evening. So cat looks pretty good. No problem. No problem, Jake. We have time for about 1 or 2 more questions if there are any. We've got to wrap it up here. MW. Well, I mean, good looking chart. This thing's broken out. I mean, it's later stage. I mean, this thing is what, over doubled, more than that even. All right. I mean, this thing is really over the past year and a half or so. I mean, it's gone from, what was this low? Somewhere around like $9.50 or so a share, and now it's at $38 a share. I mean, it's gone up 400%. That's a significant climb. So, we could be in the later stages of its development, so to speak. It's a little riskier taking on things this late, but as long as they hold up, this thing just has to base out some now. If we're to take this a trade on in Men's Warehouse now, we really need to see it form a right side, what we call the right side. For instance, we had this breakout, and then we had some sideways action. We got some consolidation before the next breakout, so we based out. Now, one thing I don't like about Men's Warehouse is we don't like to see this wedging action. Here, let me get rid of this. When things break out, you like to see them break out. This just wedged higher, which can be a sign sometimes that things are getting tired. It just wedged. I mean, it has this nice breakout, and then it set a high on this candle of 32.75, and then for the next month and a half, 2 months or whatever, it went from 32.75 to a high of $35. So all it would take when you get this kind of wedging action, all it takes is one big down day, and you can give back all the profits you would have made, in taking on the trade. So that's not ideal. We don't like to see wedging like that, but you need some base building to go on now. I mean, it's really dangerous to try to enter here because what's your risk reward? There's really no way to define it here. We need to build a right side, and a right side would mean we need some action out here on the right hand side of the chart where you get some consolidation. You get some price action where you build a base, because the base is from which is your springboard to move higher. There's really there's no consolidation now. We broke out, now we're getting this chop fest going, and the pattern needs to tighten up. But it's a strong stock. I mean, it could continue to go higher. It's just that it's probably in its later stages, just because it's run so much over the past year and a half. Let's see here if we have time for one more question. And the winner looks like it's going to be what, Home Depot here? Yeah, Home Depot will be our last one. Yeah, I mean, it's obviously, look at that move. I mean, what can you say? That's about as powerful as it gets. But now, now you need, once again, you need some basing action here, for it to set up. Right now, it looks like, we've had a false breakout. We had this little base form right here, which wasn't much of a base. It broke out, and now it's failing. And that's not surprising, given, that XRT is under a little pressure here with this dark cloud cover. But, it needs to base out and set up now a little bit. You know, could it run from here? Could you get a blow-off move? Yeah, you could, but it just doesn't offer a real clean entry or a real clean risk reward right here. I'd like to see it. I'd like to see a little more discussion. I'd like to see this thing come back down in, have a false breakout. You know, we normally don't like to see these kind of clean. When everyone's staring at a breakout like this, I mean, the whole world sees this. So it's not surprising that it might fail here. When the whole world's staring at that breakout, and they're so easy to see, clean entries are generally quite often fail. And everyone's staring at that. Now it looks like it's going to come back in. But if we can get some more discussion here, some sideways action, a little bit more consolidation, and then take another move higher, that would be ideal. A false breakout here would be ideal. But it's a strong stock. I mean, not much you can say about it. I mean, that picture tells you everything you need to know. So, you know, just needs, in my opinion, just needs a little time. It's not something I'd want to enter right here. Just not enough of a base has been built to break out from, especially given this massive run-up. You know what, I'll squeak this last one in, EFA. That was the last one. I'll get that one in real quick, and then we got to wrap it up for the evening. But, you know, I mean, there's been relative strength in this area for the past, you know, couple of weeks. I mean, you're dealing with the same issue. You're running into some serious resistance here. You know, it appears that this thing's probably got to go sideways here. We have to. It has to set up now. I mean, obviously it's running into resistance here. We'd like to see a right side form. Once again, a right side being some sideways action. Let have some discussion here to give us a setup. You know, it failed twice now. It's failed to get above the 200, and it's fighting a lot of overhead. There's no question. But if the market just heals up here, if this, or not the market so much as if this ETF just can move sideways, let's say we get a pullback in the market, and this thing can move sideways for the next 7 to 10 days, something like that, and just hold up nicely in this range, then, you know, the next attempt, the breakout probably will be successful. So, you know, it's something that that you can keep on the radar. It's just that there may be other things that show more potential in a pullback, things that have been a little more strong, have had more relative strength over a longer period of time. But anyway, that wraps it up for this evening. Thank you, everybody, for attending. And again, you can visit us at the website. Take a look at things. And if you have any questions you want to email us, you can always email us. I'll put my email up here. All right. So have a great evening. Thanks for joining us tonight, and good luck with your trading. Take care, everybody.